We're gonna get here into simple moving averages. I think it's a nice segment. It's one of the main indicators I actually use.
Mhm.
It's a screenshot from normally what I technically use. So I use a 50-day moving average with a 200-day moving average. And simply, what are simple moving averages? Well, they're lines that calculate the average of a range prices by the number of the periods within the range. So if I use the 50-day moving average, I'm taking into account the average of the last 50 days at the close of the whatever index or whatever position I'm looking at, and it puts it into a average number. So understanding the simple moving average, I think one of the most, if not the mostly used technical indicator
For
to
sure.
identify
I think so
current
too.
trends in the market and establish maybe a change in the trend. And I put here the formula, as I just said it. You just add the closing price of whatever you're watching, whatever ticker you're watching, and divide it by the number of periods you put. So today we're going to watch the 50-day and the 200-day moving average. So it's A1 plus A2, A3 divided by N, number of total periods. Some people may be asking or wondering about the exponential moving average. I want to talk about it later, another day, because it's a totally different formula, which it's more modern, but we're going to just talk about simple moving average today.
Yeah, there's many different ways to calculate averages. I think that SMA, though, it's like definitely one of the easier ones to understand and pretty ubiquitously used.
And two main special considerations I put here in yellow, Julia, about simple moving averages. Just don't try for people watching to overcomplicate. It's very easy just by looking at a short-term simple moving average. Being above the long-term moving average, it's an uptrend expected movement, and vice versa. No, when the long-term average is above a short-term average, then a downtrend might be expected outcome. The two main special considerations of simple moving averages.
For sure. And even if you don't necessarily want to use it as a technical indicator, as like an indicator for active trading, you can use it for other indicators as well. Like if you're a more passive investor, there's still a lot of utility to looking at simple moving averages, because especially if you're trying to invest long term, short-term trends and short-term volatility can sort of obfuscate, I guess, the long-term performance of the stock. So that's kind of a way to normalize and correct for those local fluctuations in price, and sort of look at like maybe what a more reasonable long-term expectation for that movement is. Although obviously anything could happen.
As the main considerations, well, it's compare pair. Too many people put into their graphs and they take into consideration the 9-day, 20-day, 50-day, 100-day, 150-day, and 200-day moving average. Then you have a bunch of lines that will only confuse you, especially if you look at a short-term period, 1 minute to the 2-minute time frame. That's why if you don't are very related with the simple moving averages, start with a 50 and 200-day moving average, and you will see that it's fairly simple to understand and watch. And that's when we get into the golden cross. I think one of the most renowned movements in simple moving averages, the golden and death cross, which we're going to talk about. Well, what's a golden cross? The golden cross occurs when the short-term simple moving average breaks above the long-term simple moving average. This will signal a uptrend, and especially if you get high trading volumes, this can be like as a double confirmation of an uptrend on the stock or index that you're watching. And here I actually put it on the graph, very easy to see. Golden cross here, where the 50-day moving average crosses the 200-day moving average, we'll get the golden cross. And this tends to be a very simple detection of an uptrend movement.
And there's like several different types of timescales that you can use, or several different sizes of timescales that you can use. There are people that trade on like the microsecond timescale for simple moving averages. There are people that trade on the minute by minute, hour by hour. We tend to trade on longer term timescales because it gives us more time to react, I guess. It gives us more time to tweak the parameters of a trade depending on how the market's moving. And we also, like, because a lot of us are volatility traders, we're trying to trade investor sentiment a little bit more than we're trying to trade price directions. So if we're trying to trade volatility, again, using like a longer term scale gives you more time to assess what's going on, but also gives the market more time to adapt to different conditions or changes or anything like that. So the size that you're going to use, it totally depends on the how actively you trade, the time scale for that trade. And it's used in pretty much every example that you could think of, for sure.
Yeah, in every asset, and either it's crypto or whatever asset you want to, they're actually, that's the benefit and the main thing of simple moving averages. They can be applied to everything.
For sure.
And then, Julia, we get to what I think we're experiencing right now in the market. Death cross. A death cross signals a downward movement when the short-term moving average crosses below the long-term moving average. In this case, the 50-day with a 200-day moving average signaled here. You can see how the movement respects. Actually, this stock we're watching is Meta, because here it death cross confirmed, and you see the price drop from around 170 to lows of 130. Julia, what I was talking about, also the constraints of the simple moving average, it's that many traders right now actually, it's unclear whether it's more important to put more importance weeks and days, or to put equivalent importance to all of the days. Simple moving average take into consideration and gives the same importance to all of the days, compared to the exponential moving average, which the exponential moving average, we're not going to talk about it, but they actually give more importance to closer days, more recent days. And this is why many traders believe that new data will better reflect the current trend the security is moving with. I don't know, what's your opinion about it, Julia? Do you think current data is more important, or will you give the same importance to all of it?
I tend to look at the current data, and I weigh that way more heavily than looking at historical data, because historical data, it gives you like a pretty, I don't want to say reliable, but a reasonable context for how an underlying is likely to move. But for instance, if there's like a big jump or drop in stock price because of like an earnings announcement, for instance, like a lot of these indicators, a lot of these averages are pretty contingent on having a pretty fluid signal and pretty like reasonable or understandable stock dynamics. So having like a jump in your price, for example, can throw these off a little bit. There's also like, if there are binary events coming up, that might get reflected in the volatility of like the options, but it might not necessarily get reflected in the volatility of the price. So like leading up to earnings, for example, like something might actually be quite volatile in the options market, but it won't necessarily reflect that in the price itself. So getting kind of like a holistic picture is pretty important. And I tend to look at the options because it's giving a pretty, approximate representation of how investors are expecting an underlying to move, which you can only take with a grain of salt, just like everything else. But for me, looking at like how the market currently views an underlying and where that risk is, that means a little bit more to me than looking at those previous price moves.
And here, what we're talking about, the title of the stream, No Man's Land. No Man's Land. This is the actual price of S&P 500. We actually see it right now on the graph, SPX, 1 year, 1 day. I'm going to take our site. You see here, SPX trading below its 50-day, but above its 200-day moving average, which actually is a no man's land territory. So either it's not a death cross, but it's not even a golden cross. So where do you go from here? And also, Bloomberg got this report yesterday. Support follows one by one. S&P 500 breaking multiple trend lines, multiple 50, 100-day, and 10-day moving averages. So right now, the price marked in black, this signals a downtrend movement. What's your take, Julia, with simple moving averages?
This is interesting. I always like to take a lot of these indicators with a grain of salt, and I'll kind of look at them just to see how they can help my trading, because a lot of the times, like a lot of these technical indicators, I think like I use them more to like get a summary of what's happening in the market to influence my options trading. I personally get a lot more of utility out of the options market compared to looking at price action, especially because like I think that like there's a lot of just because markets are so efficient, I think a lot of whatever inefficiencies that are reflected in the price signals has probably been efficiented out, I guess. I don't know how the best way to say that. So I don't think there's a lot necessarily of inefficiencies that can get detected by technical analysis, but using technical indicators for me is a very helpful way to kind of like get a holistic view of the market with like a nice summary of statistics. So that's kind of where I'm at, but I always like to look at these just not for, I guess, for fun. Yeah. Just to kind of like see, like, maybe there is something to it. Maybe this can influence my options trading, or maybe this can help me make more, I don't know, founded directional assumptions when it comes to price movements. Because I personally, whenever I guess the direction of a price and where it's going to move over some period of time, I almost always guess wrong. So I just kind of gave up on doing that a while ago. And I'm like, you know what, I'm just going to stay neutral for a lot of my positions. But, you know, trading directionally, I think like if you're going to have any basis for it compared to like fundamental analysis versus technical analysis for active traders, I think there's probably more juice in technical analysis. But I don't know. That's my take. Y'all are happy to throw your opinions in chat.